Welcome everyone, it's Brian Stream here. We're doing our Hurley Investments Market View commentary for Monday, July 20th, 2026. And last time I taught, I was asked if I could show how you balance risk, reward, and probability. And I'm really excited to show you guys how to do this because it's not as hard as you think it is, but you do have to have a couple of things in place to be able to do it. So let me just start with going over the theory, okay? Uh, the key to trading success is balancing risk, reward, and probability. And what you're seeing in front of you here is just a seesaw, right? You have equal weight on risk and reward, and probability is right in the middle, 50-50. This is this is what the market, all the market theories around and models about option pricing models and all that kind of stuff. Everything is based on the assumption that people are not idiots, they're rational. So you'll often hear the words when you start digging into scientific journals and all that kind of stuff. You'll say the theory, the the guess is that investors are rational. I would argue that they're not, because they always seem to overestimate and overreact. So they're very emotional, and I can show you articles that show that people tend to be pretty smart and they're very methodical and they spend a lot of time on entering positions. But when they're exiting, they almost always exit for emotional reasons. And that's both retail investors and pros, a lot of them. They're exiting for emotional reasons, and so their exiting is not nearly as good as their entry. But but the Black-Scholes option pricing model that helped win the Nobel Prize for the people who created it, um, who are still living, it assumes that investors are rational, and it is also assumes that because they're rational, that the pricing of the options should be fair. And that's what we're witnessing right here. This is a fair, you got equal risk, equal reward, and a 50-50 chance. This is a coin toss. This is buying stock. Um, so many people in our industry, I'm positive you've heard people talk about risk and reward. And what they're all looking for is small risk and a huge reward, right? That's almost always what people are talking about is they want to take lower risk and have a large potential reward, and they completely ignore probability. And that it's a pet peeve of mine. It kind of pisses me off because if if risk and reward were the only thing that mattered, we should all be investing our nest egg, our retirements into lottery tickets because that's the best risk reward that's out there. But we don't do that because we all inherently know that probability is a factor and that the probability of success if you invested all your money into lottery tickets is that you're gonna go broke because the probability is so low of getting that big reward. So you've got to figure out, if you want to be successful over time, you got to figure out how to balance risk and reward. So having a low risk and a big reward when the probability is not in your favor, you're going to end up with the risk. You're going to end up hitting with the risk, right? Um, you have a small risk, big reward, but the probability is not in your favor, and that puts the reward down into negative territory. If you follow what I'm talking about here. All right, so we're gonna get into this. Um, you can't. Here's the thing about the market. You can't make the market favor you, right? Uh, You have people that are smart and you got people that are dumb. Most professional people call retail investors dumb money. I don't think that's fair. Um, I think that a lot of times professional investors are dumb uh, because they're 90% of the advisors out there don't beat the S&P 500, and they say that they're smart, but they're not. Elite investors are smart money, and elite investors do a good job. They do something different than what everybody else is doing. Um, and I like to approach this with uh, a little bit of an analogy into casinos or insurance companies, right? It's really easy when you walk into a casino to differentiate who's the smart money and who's the dumb money, right? The people that are playing at the tables are the dumb money because, and you know who the casino is, and you know that the casino is winning, right? They've got their thumb on the scale and they've tipped everything in their favor, and you can't do anything about it. Um, that's not the case in the market. That's not the case with option trading. Um, the with option trading, you are you can decide whether you want to be the lottery ticket purchaser or uh, or whether you want to be the casino. And there's one thing, so insurance companies are they're also playing with probabilities, balancing risk, reward, and probability. Every insurance company is required by law to have at least one actuary. And actuaries, this is what they do all day. They balance risk, reward, and probability to make sure, and they're trying to create a fair game that leaves them with money in their pocket, right? And this is the formula that they use. They take the average reward times the probability of profit, and they add that to the average risk, which is always a negative number, times the probability of loss. And that gives them an expected return. And what they're looking for is to make sure that they can get a positive expected return. That's what they want, positive expected return. And so this is you can an example, and I'm just showing you what these this seesaw, um, which is just showing you that depending on where that fulcrum is in the middle, if the probability you can it doesn't matter what probability is. If you're balancing risk reward, you can have a big risk and a little reward, which is the exact opposite of what most people who are talking about risk and reward are talking about. But this is exactly what insurance companies do and what casinos do. They have these great big risks with lottery payouts, with insurance payouts, insurance claims. They've got these great big risks and they're taking in a small reward. But because they balanced probability appropriately, they end up with positive numbers in the account. It's all based on the way that they balance this formula, which I'm going to get into and show you some examples. You can also have a little tiny risk and a really huge reward that works out if the probability is in your favor, right? So all we care about is making sure that when you run that calculation, when you run this formula right here, you end up with a positive number. You want the reward potential to be higher than the loss potential. So here are some numbers to show you how this works out. All right. So average reward and average risk, if you don't have a history that you can go back to your methodology, to your trading system and say, well, this is what I make on average when I win, and this is what I make on average when I lose. This is how often I lost, and this is how often I win. Um, You can use those numbers if you have a track record, a history, you can use those numbers to determine average risk, average reward. There's a really gnarly calculation that you can use to figure out what average risk and average reward are on a new trade that without any history. But I'm not teaching calculus just because. But it's out there. So if you really want to find it, you can find it, and you'd be able to calculate that. I'm going to show you the quick and easy way, which gets you approximate. Okay. Um, but if let's say I want to buy a stock option and it's going to cost me $1.50, or my reward potential is $1.50. So this is a high risk. You're risking $8 to make $1.50, but because you have a 90% chance of success, so you're going to win most of the time. You might win 9 times out of 10, you're going to get $1.50, and 1 time out of 10, you're going to lose 8, is what this is saying. And so this is an adverse situation compared to what most people are looking for. They're looking for small risk and large reward. This is the exact opposite. This is what insurance companies are doing right here. And you can see right there, on average, if they do a trade, every time they do a trade, on average, they're making 55 cents. And that's a good bet. And when we flip the scale to the opposite side, now we want a big reward. So let's say we do an option trade, and our reward potential, our average reward is $8, and we're risking $2 to make $8. Our probability of profit is only 33%. If we take that 33%, we're only going to win 33% of the time. So 1/3 of the time we make $8, 2/3 of the time we lose $2. And that has a positive outcome as well. On average, if we do these trades over and over again, we'll make $1.32 profit. Any positive expected return is telling you that things are weighted in your favor. Okay, so we can't make the market do what we want it to do. We can't make the market give us an advantage, but we can recognize when the market is giving an advantage, and make decisions whether we want to enter the trade or not based on that. This is the hard part. Where do I get probability of profit, right? There are many places out there where you can get data that will offer probability values these days. However, a lot of them don't. And if they don't have probability anywhere, you can get an option chain. You can usually get implied volatility. If you get implied volatility, you can calculate probability. And if you don't know how to do that, don't worry. I have a spreadsheet that I'm going to send. So if you guys go into, let's see, I have a handout here. There should be a handout at the top of your screen that's showing here. At the very top on the right, there's a little, it looks like a file with a paper clip on it. And you'll see there's a spreadsheet there that you can download that says expected return and probability spreadsheet. All right. So I am going to show you what that looks like. And we're just going to try looking at a trade right now to see how this works. Okay. So I'm going to look at Micron because, we're looking at trades. One of the trades I was evaluating today, because Micron kind of took it a little bit head on recently and has dropped. We can go look at that. So what I'm going to do is go here, and we're just going to take data right from Money Block. So normally right here, money block, when you look at an option chain, you can change the settings right here so that you get implied volatility, which I have on there, but it's not showing up right now. And that's because I think because the market's closed. So when it was open earlier, it did show what the volatility was for Micron. And you're just going to do an average of the implied volatility of the call and the put. You just calculate the average, and that's what you use. And typically, I'm going to go to get my implied volatility readings. I'm going to go to the most popular option contract, which is the option contract that's just out, the closest one to about 30 days out in the future. And I'm going to use this on, even if my option goes out to December or whenever, I'm going to use that implied volatility because it's giving me the most, because it's the most popular, I'm getting a better opinion, a better survey of what investors who are investing and putting money at risk, because that's the most popular option. I'm getting a better idea of what they're expecting for the stock in the future. And implied volatility uses something called standard deviation in the calculation, and standard deviation is equal to probability. And so that's what we're gonna, that's why we're using implied volatility and how we're getting implied volatility to do the calculation for probability. Okay, so one of the trades I was looking at, if I just want to do a 100 point wide bull call spread on, well, let's say 110 points. Okay, so I'm gonna go up here and I'm finding the stock price. The closing stock price was 865.46. So I go to my spreadsheet. Oop, go to my spreadsheet. 865.46. So the strike prices on Micron are 10 points wide. So the closest, the at the money option would be, because it's slightly closer to the 870, I'm going to put in the 870 strike right here. And I was going to do 110 point spread, so I would go to the 980. I got 110 point spread, and when I looked at the cost earlier, it was 38.95. Let's look in here. So the midpoint here is 39.13, because that's probably what I would do, is I'd try to get that midpoint. So I put it in and let it go. So I'm going to put the price in at 39.13. And the reason I'm doing this is because it's going to help me to know where my break evens are. It's going to help me to know what my max profit potential is and all that kind of stuff. So the break even is going to be the lower strike plus the cost here, and that would be my break even. The max profit is going to be the difference between the strikes minus the net debit. So in this case, 70.87. So now what I'm going to do is I'm going to come over here, and the volatility, when I looked it up earlier on here for the 30-day, was 102. Okay. Oop, I keep doing that. It was 102. So I'm putting 102% in for volatility on the spreadsheet. The target price I'm going to put in two target prices. First, I'm going to put in the break-even point. So when I did this earlier, the break-even point was a little bit higher than it is now. So 909.13, I'm going to put that in here, 909.13. And then I'm going to put in my max profit. So max profit happens when the stock closes above the upper strike. So I'm going to put 980 in here. And that's where my max profit will occur. And then I put in my entry date, and I just put in today's date, or you could put in tomorrow's because we can't get into it today, so we'll have to get into it tomorrow. So I'm going to put in tomorrow. It's going to calculate the number of days till expiration. I did this going out to December just because I want a little bit of time to make sure that this thing's going to work. And this table down here is giving me all of my probabilities. So the probability of finishing below the first target, I've got a bigger probability of loss than I have of winning. So probability of finishing above the first target, the break-even point. So this is the probability of profit in this trade is 47.04. So now what I'm going to do is I'm just going to go back to that expected return formula, 47.04. That's the probability of profit. And this is, if I had average number, I would use average, but I don't. I have just the actual risk. And so in this case, we said that was 39.13. So plug in 39.13. And the average reward, I'm just putting in max reward. So I'm putting in the break even and the max profit, 70.87. And it gives me a positive expected return. So this now, if I have average number, it's going to be more accurate. But this calculation using max profit and max risk is usually good enough. It's good enough. If it's a positive number, then I'm okay. So this is saying if even though I'm losing a little bit more often than I'm winning, if I did this trade right now with this extreme volatility, because that volatilities of over 100%, that's pretty extreme. That's high volatility. But even if that volatility is high, if it continues to stay the same going forward till December, I can expect on average to make $12.61. And if I can figure out what that is in percentage terms by taking this number equals this number divided by the risk on average, I can expect I'll make around 32.24% in this particular trade. That's how I balance risk, reward, and probability. It could be totally different numbers, and you can play with it. Like, what if I only win 33% of the time? You can put that in there. That's not good enough. That's not good enough. What if I win only 40% of the time? That is good enough. So you can play with this a little bit and see, how the numbers go out, but it just helps you to balance risk, reward, and probability. And you're always just calculating the expected return. And what we're using is not what Brian thinks. What we're using is what do all the market participants who are trading and putting money into Micron, what do they think about what are they expecting this year? And what are they expecting in the near future? And if they're expecting this thing to keep on moving, then I have a really good shot with this risk reward and probability outcome. I have a really good shot of making money. Now, this is the hard way of doing this. If you're doing this by hand in a spreadsheet, you're doing it the hard way. It's not always easy to get the information that you want and type it into spreadsheets and all that kind of stuff. Don Fishback has a really good software, and it's more complex and it's more accurate. This is the easy way. So this is done oddsanalytics.com right here. I'll just go to the site and show you. This is the website where Don has. I think he charges $7 a month. I think I that's what I get charged, and I just did it as if I'm anyone else. $6.99 is a monthly charge that I get for this software. Um, and that will give you the ability to go in and look at this screen right here. You type in the stock you're looking for, the expiration date that you're looking for. It'll pull this graph up, and it shows you right here. This bell curve is showing you what the market is expecting, and then this big histogram right here showing you how the market has actually moved over the last 4 years. And you can change the settings on this so that you're looking back 1 year or you look back 4 years. My statistics professor beat into my head that you have to have at least 1,000 data points. And so I do 4 years because that's 1,008 trading days over a 4 year period. So I know I've got sufficient data to give me good statistical analysis. And then what you have down here is you've got the current bid and ask prices of these options. And this I did the 880. This is earlier in the morning. I did 880, and you can see that the 202 ask price of that option, the value of the option. So if the stock continues to behave the way that it has over the past 4 years, the you want a price that's less than 136.76. So this tells me right out of the gate that I can't get this call option, because if I'm bullish on the stock, I think the stock's going to go up, but $202 is too much to pay if I'm balancing risk reward and probability. And our guess is that the stock is probably going to continue because people are not rational. They really aren't. Um, it but if you look back at what they've actually done over a 4 year period, it gives you a better idea of what you can expect. And so, and this was something Maud had asked for. She wanted me to show how I can value options. This is how I do it. These formulas are complex. They're and Don Fishback is the only one that has it set up like this. So I don't know anywhere else where you can get this kind of analysis. This is what the value should be if the stock continues to behave the way that it has over the past 4 years. And so I need to get a price that's less than 136.76 in order to have an advantage and a positive expectation. So what we do, and you guys know this, we sell calls. We do bull call spreads. Um, we sell calls and get somebody else to pay the bulk of our option price that we want and the position that we want to be in. And so I can get this. I can get a long position. It has a ceiling. It has a max profit. Um, if I could do this for less than 136.76, then I would just want to buy a call, right? If I could buy a call for less than that amount, then I would just buy a call because I have unlimited profit potential to the upside. But because I don't, because this is expensive, this is ridiculously expensive, I'm just going to sell another call to get the price down to something more reasonable. And in this case, I got it down to $39, and that gives me a good bet. And I have a positive expected outcome, and I can keep going forward. All right. So that's how I balance risk, reward, and probability, and that's how I do valuation of options. I just put the data into Don Fishback software. You just look up the price of everything, and it'll tell you what the value is. And if the current ask price is less than the value, then I know I have a positive expected outcome, and I know what the value is because I believe that the stock's going to continue to behave the way that it has in the past. There's no reason to think that it won't right now. Um, and and so that's what I do. It's really fun. Let's see. I got some questions up here. Let me just. You're not having any luck. it's just the so if you where you're asking questions, Nathan, right next to that question box, there's a materials. If you put your mouse over it, it looks like a paper with a paper clip on it. But if you can't get it, just I'll send it to you. I'll send it to you in an email, and that works. Oh, you got it. Awesome. Perfect. Awesome. All right. So yeah, so that spreadsheet is it's complex. There's a lot going on in there. And if you still have questions afterwards, just let me know. I can talk to you. We can go over things and how it works. I've been doing this for a long time. Um, all right, so I want to talk a little bit about. Oh, I got to pull up my other. Some interesting news, right? I found this on Bloomberg today. Short bets against the U.S. equities hit a record as AI risks mount, and this is actually really good news. Okay, for me, this is good news. Bearish bets across U.S. stocks are surging to a record in the face of market gains, reflecting anxiety about the staying power of the rally. Short interest in the S&P 500 index stocks is sitting steps away from an all-time high, and the short interest in the Russell 3000 companies has recently climbed to a record. Why do I think that this is a good sign? Because the market top never happens until everyone is just resigned that the market is totally bullish. So you don't get the tipping point that tips over and everything crashes and starts heading back down until everyone's completely sold that it's not going to move that way. When all the buyers who are going to buy have bought, that's when you want to worry about the tipping point and a sudden quick crash. But as long as there's a good number of people out there who are not yet convinced that the stock's going to go up, there's still people out there that are left to buy. And I love that people are shorting, because if they're shorting, they're they if the market keeps going up, they're going to have to cover, and that makes the market go up even more. So when those shorts finally cover, that's when the shorts cover and people bail out of the short positions. That's when I'm going to be a little bit more worried about the tipping point and things turning around and heading back down. I think. Oh, this was a fun comment. It was in here. Uh, SpaceX was the ninth most shorted stock in the U.S. market before Friday's drop, with 25 billion in bets against it, representing nearly 29% of its float. SpaceX shorts are up nearly 28%. Now, I want to point out that they're just looking at the numbers the um, and they're looking at the prices of the options or the prices of the short positions. And because the stock is down, um, they're saying that the shorts are up nearly 28%. But that is not actually true. And the reason why is because when you short a stock, there's a few things that you have to do, right? When you borrow stock from someone to sell it, they loan it to you, you have to put it back, and but you also have to pay an interest rate. It's called the borrow rate. And when I looked at the borrow rate, because I was interested in shorting SpaceX right as soon as it was available to short, I was interested in getting negative on the stock because I thought it was ridiculously priced for a company that doesn't have good fundamentals. And so I looked at the borrow rate and it was 54%. So yeah, they may be up 28% right now, but that's not including the borrow rate. The dollar figures might still be there, but they haven't paid interest on the shares that they borrowed yet. So it is not up that high. Um, I'm positive and with the borrow rate that high, it's really, really hard to make money on the short. So when borrow rates get like that, I don't even bother. I'm not trading it at all. There's no money to be made in my opinion. Um, it's just not sound. So the people who are making money are the brokerage firms that are loaning out shares of the people that are making the borrow rate, right? That's your brokerage firms usually. They're the ones making money on SpaceX when people have bought into it. They're loaning out the shares and cashing out big time. That's the only people making the money on SpaceX right now, I think. Um, And then the cool thing about this at the end, earnings season and geopolitical concerns will be big factors for the rest of this month. And I think earnings are going to be awesome, and we are keyed into it and very excited. Um, and we'll go over which companies are announcing earnings this week in just a minute. The briefing.com big picture. There's only one thing I agree with in this whole article, but so I'm going to bash this quite a bit. Uh, they're talking about rotation away from growth stocks reinforce why diversification within an equity portfolio remains an essential risk management tool. Hogwash. They're listening to academia. They're listening to the 90% of other people out there. Diversification does not mitigate risk. Diversification across sector styles and market capitalization will help cushion losses when market leadership changes. Hogwash. It does not work that way. Diversification reduces volatility in your account, but it does not protect you against losses. Um, they keep saying diversification still matters. I'm going to quote Warren Buffett. All right, Warren Buffett and Stan Druckenmiller. Warren Buffett said, and I've got videos of this on my website, brianstrain.com, in a blog post. Um, So you guys can go watch it if you want to, but I'll tell you what he says. Let me go there real fast and I'll show you. Um, my blog section. This one right here, a story about investing and lessons I learned. Oh, not that one. I thought it was that one. It's not that one. It's this one. 90% of fund managers don't beat the market. That's what it is. And you'll see these videos right here, Charlie Munger and Warren Buffett. And the quote that I always quote out of here is Warren says, if you practice diversification as taught in modern finance, we take that as a mission that you do not know what you're doing. That's what he said. Stan Druckenmiller, talking to some other people, and he's talking to people at a college I think he's at Duke, and he says, "Yeah, I'm not sure what you guys teach about diversification here, but I like to put all of my eggs in one basket and watch my basket closely." So these are elite investors, right? These are the elite of the elite that have track records showing that they're beating the indexes most of the time. And it's because they're not diversified. It's diversification is killing. The diversification is a guarantee that your returns are going to be about average minus the fees that you pay, right? Um, and so one of the other things that was said in here, investors, yeah, potential catalysts that could come up for unwinding momentum trades. They missed one in here too. Momentum trades in semiconductor, hawkish commentary from the Federal Reserve, rising oil prices, concerns about increasing speculative positioning, including leveraged ETFs and contrarian sentiment indicators suggesting positioning had become overly optimistic. So they're saying, why is the market going to turn? These are all reasons it could be. They left out the war. They left out the war with Iran. I was kind of surprised about that. Um, but then they put on here the technical damage isn't catastrophic, but it serves as a reminder that leadership can change much faster than investors expect. Yeah, it can. Few invest. This is what I thought was funny. Few investors can consistently predict those rotations correctly, which is precisely why diversification remains valuable for dummies, right? For dummies. If so, here's how easy it is to say which stocks are carrying the index. Go to your browser, put it in AI mode, and say list the top 20. So if you have 500 and well, I accidentally put 550, but that was an error, and it figured out what I was saying. 500, the SP 500. Rank the stocks by the percentages of the index, right? So uh, the index has 505 stocks or 500 stocks, and if you we know that over the last 100 years, 4% of the stocks account for 100% of the market gains. And if the index that represents the market, the proxy for the whole market, has 500 stocks in it, you know you only need the top 20 because 4% of 500 is about 20. So just look down this list, right? Which which ones are the top ones in the S&P 500? Which ones are the top market cap? The greatest percentage of the index? NVIDIA, Apple, we have those. Alphabet, we have that. Broadcom, I have one of those. Meta, we got that. JP Morgan Chase, I think a couple people have that. Micron Technology, Netflix, Walmart. They're listing the stocks that we own, right? This is what we're doing. It's not rocket science difficult to figure out which stocks are carrying the index. Those stocks are more volatile than the rest of the market, and so you only need 20 stocks. And so I put it together a spreadsheet. I'm just trying to show you guys. Let's see, where's the other one? Is it down here? Oh, there you go. Yeah, so these are the stocks that we're in right here. If you just bought one share at the beginning of the year, so the Magnificent Seven stocks currently make up approximately 32.5 to 35% of the S&P 500 total market value. If we just go, these are the stocks that we have, where we've done all the fundamental analysis, we've done that stuff. The only one that didn't show up in that list of the top 20 stocks was Ford, and that was because that's a value. That was a value investment. And it's positive. But if you just go and say from the beginning of the year, you bought the stocks that we have, some of them are down, a few of them are down, a few of them are up really big. But if you just sum those totals up, if you bought one share of each of those, you'd be up 26.28%. The S&P is only up 8.22%. So and this is not factoring in any of the option strategy that we're using. So we've taken some profits off the table and we've added shares on a few of these, and so we're doing something that should hopefully even be better than this, right? Because we buy protection. We protect our asset to make sure that we're not going to lose if the stock takes a big downturn. And some of these have taken some big downturns. Netflix and Palantir, and Disney, they've taken big downturns, but we're not worried about it, and our accounts aren't losing so bad because we've bought protection on those and we've been profiting from that protection. So that's I just want to reiterate, I'm totally sure that we're in the right assets and we have the right strategies to do the best thing that we can for each of you. And if you guys want to play with this and find stuff on your own, it's really fun. I love doing this. I love digging into the numbers and running the numbers and the math and finding these kinds of assets. It's a blast. All right. Um, oh, and this is the only thing in that briefing.com article that I agree with. It's almost like their one line disclaimer. Diversification within an equity portfolio cannot eliminate market risk. Uh, that's we know that. So it's like they're spending this whole article to tell you that this is why you should be diversified, and then right here they say, oh yeah, but you can't eliminate market risk. Well, our strategy with buying put options to protect against the risk. Where will our markets end this week? I think this week we're going to end higher. We have some earnings coming up that are probably going to help us. Um, so even though technically some of these things are Dow Jones, which we're not necessarily into any of those stocks, but is headed down towards the 50-day moving average. Technically, it's not quite bearish yet. Um, SPX did cross below, but it's kind of bouncing. It's kind of hanging on right around that 50-day moving average. And I think this week we're going to get a nice little push there. And you can see volatility has been climbing up as we get into earnings season. Um, and it's right about volatility is right about average for this. So that's kind of interesting. NASDAQ has been bouncing back and forth around that 50-day, and it's down a little bit low, but if we get a good earnings report this week on Google, things like that, we should probably be able to see it go higher. Where will it end in June? I think we're going to be positive by the end of June. Um, we had last week was a rough week. It was kind of rough, right? It was difficult. Uh, the S&P was up 1.5, 1.5 in the first 2 weeks of the month, and then down 9. But if we have a good week this week, I think we'll end positive. Earnings coming up this week. Zion's was today, and uh, we've got KeyBank, which we've got positions in KeyBank, and that earnings is tomorrow. Then Wednesday we've got Google, and those could be those could be great. Those earnings could come in and be great, and we could see a nice big jump. And it doesn't matter. They could come in and be really bad, and we could see a nice big drop. The nice thing is that's why we've got protection on both of those stocks that are in our portfolio. We've got positions to protect so that if they do go down, we can be wrong about what we expect and see the thing continue to go down. Oh, did I say something else? Sorry, James. Yeah, I meant July. Oh, that's it right there. Yeah, I see it. Thank you. Let me fix that. Copy and paste the different things. Forgot to change that. Awesome. Um, we haven't had economic reports coming out for the past 2 days, but for today and tomorrow, we don't have really any economic reports. So we'll just be watching those earnings. We do on Wednesday. We've got um, the mortgage stuff, Atlanta Fed inflation expectations, petroleum status, jobless claims on Thursday, natural gas report, manufacturing index, Fed balance sheet, PMI composite on Friday, and new home sales. So I don't think any of the economic reports are going to be giving us any. I don't think they're going to be giving us that much this week. I don't think people are honed in on those things. They might be a little bit on petroleum status on Wednesday, but really that even whatever the petroleum status has been, they've been reacting more to the news about uh, what the what prices are happening based on the war going on in Iran and whether the strait is open or not. So I think if you pay attention to that kind of news, you'll probably be just fine. Um, how am I looking to trade? The same way that we the same way that we always do. This is what we're doing. We're balancing risk, reward, and probability with our strategy. We've got a solid strategy that works well. We're invested in the right stocks that are carrying the indexes, and it's just a matter of time. We've got a lot of open positions on Micron that we're just waiting for time to fall off because they're so deep in the money, and we just need time value to fall off of those to see the gains happen. So we'll keep watching that, and we may want to add some more Micron positions because stock pulled back and it's kind of cheap, but the fundamentals of those things are all still fantastic, right? The that's I don't think that's going to change in this year or maybe even next year. I don't think that's going to change. People are still piling tons of money into AI. They need AI, and they've got to have the hardware to do it. So anyway, it's I think this is a fun time to be an investor. This is a really fun time to be an investor. I don't a lot of people dislike volatility, and that's why so many people have there's more ETFs on the market right now than there are stocks. And it's because everybody thinks diversification is going to save them for whatever reason. And people are piling into them like crazy. There's a ton of money out there to happen. I love volatility. I don't dislike volatility at all. And I'm hoping that you guys are feeling that way too. We love it when we get volatile stocks, whether they're going up or down, we don't care. As long as they're making big moves, there's an opportunity for us. And we don't even have to guess right because our strategy is, I think it's going to go up, and I know it will over the long term, right? Because that's the stock market has always done that. It always goes up over time, and it'll get there eventually. But the volatility is just really fun to play with, and if you know how to recognize the value of the options and how to price them and how to balance risk, reward, and probability in your favor, that's why we do so well at what we do. But all right, any questions from anyone? I'm going to stall here for just a little bit. Um, if you have any questions, and if you have questions on the spreadsheet or anything like that, you can definitely reach out to me. My email address is just Brian at Hurley Investments, Bryan at Hurley Investments. My parents spelled Brian the Scandinavian way, and so that's you can always reach out to me. This week is going to be rough. I'm going to be uh, getting on a ship on Thursday, and so I'm going to be traveling. I'm going on an Alaskan cruise this week. I will have an internet connection once I get on the ship, once I get there, so I should be available again on Friday. But Thursday I'm going to be probably pretty unavailable. But if you have questions, you can always ask other people too. All right. You can ask Kevin, you can ask Keeve, they can answer your questions too. But they will refer you on the probability calculation because I'm the math geek, I'm the volatility geek. So they'll refer you to me on those things. But um, all right. Awesome. Thank you, Maud. Thank you so much. Any other questions before we take off? Awesome. Thanks so much, Nathan. Um, all right. It sounds like we got no questions coming in. So if you do have questions and you think of them later, please do reach out to me by email, and or you can call me either way, um, and I'll be happy to visit with you and make sure we get the questions you need answered. All right. Love you guys, and I'll talk to you next time. Next time. All right. Thanks. We'll see ya. Bye bye.